Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Well, it is the end of the week, and yeah, let's see here. Do we have anything interesting here on the docket? We do have U.S. import prices and some Canadian numbers. But it's like that rare no news Friday. You got to be careful about these ones because, like, traders tend to do badly on no news Fridays. You're either gonna have like a super choppy day, or people decide like this is the day to move and they move tons of money. So that can really catch people off guard. I think for us, we might do a little bit more programming, perhaps. I don't know. We'll see. We'll see. But let's come in and look at the charts here first of all. Kind of take inventory after yesterday. Well, you can see here just on the daily chart in the treasuries, the downtrend that we have been on since the 12th is really actually quite a powerful downtrend. And I personally am not convinced that this is a very sustainable trend. Are we really going to go all the way? Maybe down to this ATR stop area. But like, are we going to go down to the lows over here? That I just really don't think that'd be justified. But we'll see. Here you are on the intraday chart. The Treasury here, seeing some overnight selling. S&P 500, not doing so hot yesterday. But it seems to have recovered most of that in the overnight session. Here's oil, a brief spike up, but that didn't hold. Gold and silver giving up some of their big gains. Wow, silver really got hammered yesterday. That's crazy. And copper just kind of, should have expected that one. Japanese yen also continues to move down persistently. So it seems like this carry trade. I think that that's a major factor behind what's going on here. I don't know. Maybe that's good if tech companies start hiring again, right? Because I'm a little bit concerned about some of the things I'm seeing in the economy. Anyway, we got Bitcoin out still above the 100,000 mark, so, but not too interesting of action going on over there. And when we come over here to the DOMs, just the first 7 minutes or so, really not a whole lot happening. Very slow pace, like the number of level 2 changes that you're getting overall very low, extremely tight range, not very much volume at all having traded, no icebergs or anything like that. So this does look set up, at least at the moment, to be a very slow and choppy day. And let me remind you that being superstitious is bad luck, and there's absolutely nothing special about today's date and day of the week combo. Absolutely nothing special about it, because being superstitious is bad. Don't screw it up, all right? All right, so don't screw it up, and we should have a good day. Now, I need to come and check the weather report, because it snowed. It snowed. And I'm thinking, hey, maybe I can convince my mom to watch the kids. Maybe I can convince... Well, no, it looks like that Snow Basin, at least, did not get any snow. I got snow over here, but they did not get snow up at the resort. That's so dumb. That's unfortunate. Good morning, Uzi. Good morning, Activities. And good morning, Ray. Ray has been up there, one of the first people saying hi every day, like all week. We appreciate it. What was I doing yesterday? You know what? So I got two things. I think I've got two things that I want to look at for programming. The first one is that strategy that we were messing with yesterday. The degenerate gambler. And I think, no, not indicators, strategies. Degenerate gambler. And I think that we said here, we only want to trade it when it's below a certain R2 threshold. And I said, I don't think that that's doing or working the way that I want it to. And so we just crossed it out. But I do think it's an important filter for this particular thing that we're trying to do here. And the R2 threshold here is 0.9. So how is that actually making a difference? Like, that shouldn't actually be doing anything. Have it on equal risk reward right now, right? Oh, no, I don't. I have it on crazy risk reward, actually. Okay, but what if the R2 threshold is below 0.5? Is that better? No difference. And no difference on that either. Well, anyways, the thing that I wanted to check, because basically this is filtering to times when there's not a lot of trend. And I think that what we actually want to do is we want to filter it to times when there is a lot of trend. Now, that didn't make much of a difference either. Why is that an or? Was that an or before? Maybe that's why I was having a problem. Maybe that's why I wasn't taking my shorts. There we go. Okay, but that really filtered it down. Very, very interesting. Okay, but that is a little bit more like what we want it to do. -3 5.5. Here on these. I think so. Yeah. Is this going to be too many? I think it should be okay. Okay, 2,600. That's not bad. Let it do its thing. Short 06. I don't know, man. I tried to not say anything to like talk people out of trades or anything. I do think in this case, if we were to take a trade, that the trade would be short. But I think that the pace of the market and the context and everything else that we got going on strongly suggests that we not take trades. Let's see how this one goes. You know what? Abort. I was just thinking here. Just had an idea. Where is this? Is instantiated on each optimization iteration. False. Am I even using the daily ATR period on this thing? I don't think that I am. That's probably why the optimization runs are taking so long. Okay. Let's see if that speeds things up. Okay, it does not like. That part. Okay. Guess maybe it does need to be. Nope. Actually, it was not that. Where's my output window? Outside the bounds of the array. something is using it. Oh. Wait, I thought I commented that out already. Wow. If you can get it to work without being instantiated on each optimization iteration, I don't know if these parts work with that or not. Come on, come on, come on, come on. Thinking hard about it this time. There we go. Let's see here. Octavia says today might be my last trading day for the year. Next week. Oh, no. We have a Federal Reserve meeting next week. So I think you will get some action. Then after that, yeah, no more trading the rest of the year. Kind of wondering what we should do over here. Typically I'll spend this time, I'll take that week off and do script writing and recording videos. But we've been pretty up on that. And most of the big projects that I've kind of had, we've been able to make significant progress on. So maybe that's another place where I should be doing Rust. I suppose we could just stream doing Rust. This is still taking a long time. I'm not entirely sure. What makes it take so long? Maybe it's just that that Fourier calculation is just really, really expensive, I guess. Well, let's stick with it. It's been, what, 2 minutes? It's about an eighth of the way through. I think that could maybe be okay. I'm probably doing a bit too much optimization here, but it will really answer all the questions. So let's pop over to Reddit. Well, the first post that I see on Reddit is there a fundamental reason or news why NASDAQ is rising so much in the pre-market today? I don't think that I have one. Other than that they just want to recover the losses from yesterday. It is a little bit weird. I took a ride down the Facebook New Jersey drone sighting group rabbit hole so that you don't have to. Observations. 80% of the videos posted are clearly, and I mean clearly, planes or helicopters. Yes. 10% are so bad you can't tell what's going on. 5% are interesting but still not clearly identifiable. 5% are UAP-ish. I didn't see anything that are clearly identifiable as terrestrial drones. Yeah, you know, I haven't been as interested in the New Jersey story because I just see too much nonsense being posted about it. Okay, you come back here real quick. Are we using memory? Do I need to turn off the... Yep. Abort, abort, abort. Oh dear, and Ninja Trader's not giving it up. Okay. Let's do something. Strategies, new strategy. Base strategy. Advanced base strategy. Save history equals false. In the config. I think I had to do, so it's not this one. So this I do base strategy, but I think on this one I have to do something. Oh, maybe not. That's only if I don't want it to show up. Oh. I changed the wrong file. Supposed to be this one. That's a little better. That cuts down on the excessive memory usage. I think that it was not going as quickly as it could have because it was starting to use up too much memory. Now on the split side of that, I've got a couple of tabs open here that I can probably get rid of. Like having opened those Google applications is usually not helpful. Oh, it's still using 5 gigs. Okay. Abort. 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 Just do that. That takes out a lot of the iteration. Oh my. I think that optimized itself too much. I think that optimized itself too much. But what parameters was it choosing? Target 1.8 and stop 2. Okay, so I have a little trick here. I have a sharp filtered. We go to the sharp filtered? Maybe. I want to try one other thing before I do that. And that was try the opposite. So changing this to negative will basically make it take the opposite signal. I'm browsing here on Reddit, and I see this this headline: securing the nugget supply chain, a case study. But it's the NuGet. The NuGet. That one actually worked better, but which parameters is it using for this? Target 0.5, stop 5. Another thing we can do is if we use a lower number here. I'm having a hard time seeing how it went from like 77,000 trades down to like 18 though. That's a little bizarre. I'm missing something that like there must be certain targets are too far or something. I don't know. It's not doing what I expected at all. It's not doing what I expected at all. So these were using target 0.4 and stop 5. Maybe that is an error in the is instantiated each optimization. Doesn't every week suck when you lose? No. What, whether or not my week is good or not should have no correlation to how much money I made. Guys, now let me tell you something. If there's one thing like on psychology, maybe I should make a video about this, because I'm starting to realize, like, okay, here's something about the psychology side that I do believe strongly about, and everybody always wants to talk about the psychology, so like maybe we should make this video. You have to be able to detach who you are from your trading. You have to be able to detach who you are from your trading. Your performance in your trading is not a reflection of who you are or what your value is to society or anything like that. I think that a lot of people get into trading and like that's what they're trying to do, is they think I will be a successful and valued person if I am able to successfully navigate the markets. And that's why they're doing it. But you've got to be able to, that's a trap. Because what happens is then when you lose, the mental effect on you is that much more extreme. And you might sit down and you say, well, I've just got to learn to like detach my emotions from what happens. But that is really kind of almost impossible. Like your emotions happen for a reason. And if you're not getting the emotions, like there's something wrong with you. So you kind of got to be careful about that. And emotions are kind of like a base state that can help your brain. It can actually help your decision making and so forth, right? So you don't want to turn your emotions off. But your emotions are going to be very heavily connected to ideas about yourself, right? And so by attaching this idea about yourself that I am my trading, then when you lose, your brain goes, your emotions just go into a panic. When you lose, it's like, oh no, this threatens my place in society. This threatens my legacy, whatever the deal is, right? And you will just fall apart. You just fall apart. And this is why you get all of these guys out in trading that's like, they have a really hard time taking a loss. They optimize towards strategies where they basically never have to lose. And then, they want to go out on social media, tell everybody how much money they're making, and then blow up. And then they don't tell us when they blow up. And or get lured into full-on narcissism. And why is that? It's because they identify with their trading too much. Is the way that I would put it. They identify with their trading. They confuse themselves and their self-worth with their trading results. Okay, so the is instantiated each iteration didn't change anything, so it's not that. I have a 15. Well, so if you have my edge goes down a bit on Friday. It's not the best day statistically, but still nice positive expectancy. But then the question on that one, I think that you would probably have to, if you were doing stats and stuff, like if you're going into journalytics and you're looking at your stats on Fridays versus other days, I don't think that today would be a very good test case, because normally on Friday you have some sort of a big headline news event that comes out. Even when it's not non-farms, there's PCE, there are inflation expectation surveys on Fridays. Like the no news Friday is very different. The no news Friday is very different. Okay, so that's still not doing it for me. It does seem like the opposite is a little bit better. I want to see. This one was FT threshold 3, and these ones are FT thresholds of -2, aren't they? Yeah. And these were FT thresholds of 3. Oh, wait a second. Yeah. Okay. Gotcha. Gotcha. All right. Over here on this, there was about like the last daily Fourier one that we did. Was it? That's interesting. When you do it on multiple instruments, it comes out as multiple backlists. Okay, we're just gonna remove all that. I've separated news Fridays versus no news Friday, and actually the expectancy still remains very similar, actually, because I'm trading a time window, which is outside the news. I would still think that the news would have a really significant effect on your results. I have this kind of overarching theory, though, that the reason that I tend to do poorly on Friday is because I do not understand the end of the week rebalancing flows. So let's try and game that one out. What we've seen here lately is downtrends and like kind of short-term reversals back up, but the overall downtrend. So that would suggest that traders are probably net short. If they're going to close their positions go into Friday, does that mean that we should see buying? Also, when we see positions closing, it tends to be we tend to be opposite of order flow signals. So like if you see a strong impulse in market orders, like the beginning of a contract, that's a really good signal to go long, but at the end of the contract, it's a signal to do the opposite. Or at least that one we don't have enough data to completely support, but we have some preliminary data to support that idea. So does that mean that we should be looking for a long? We should be looking for a long in a place where it seems like there's an imbalance in market orders going short. I think would be the trade. I am seeing a little bit of an impulse long coming in here in the treasuries in this really tight zone. So that's kind of like the opposite of what we're looking for. I don't know. Yes, do you use the DOM or the heat map? I don't use the heat map. I don't even put them up. But it seems that you're trading extremely discretionary. Yeah, so what I do is I have a bunch of different things that I'm looking at that are predictors of what the flows are going to be that day. And then I'm looking for confirmation of that in the order flows. So what I am doing is something that I think we could make quantitative. I really do. The problem is like getting the data. And there are parts of what I do that are intuition based, for sure. But I really think that I could duplicate the intuition using large language models and stuff. So the real kind of thing that prevents me from automating the strategy is the appropriate data and I guess the time to program all of the things, because each one of those little predictors of order flow that I'm looking at are something where you could probably come in and make a model for them, right? You have to make a model for every one of those things, and that's like dozens of different things, so I don't have the time. But if we were at like a large firm, I think that we could probably automate it, or at least a large portion of it. There might be some data sources and information that just doesn't exist that you need, but okay, that is more like what I was looking for. So, and I got it to be doing on the plus side and the negative side, so that's cool. And what did it come in on? It wanted a target and a stop that were actually larger than the range, than the ATRs. That's curious, but that might just be because it causes them to take less trades, I suppose. Let's look more into the summary of this. Okay, so our winning trade is a little bit less than our losing trade, especially on the short side. My probability is actually really good. Now that's interesting. Okay, so this is only 1 year's worth of data, but the probability that I'm getting on that actually kind of makes this one of the more promising strategies that I've backtested. And look, the Sharpe ratio is above 0.5. Maybe this is actually worth messing with. But I absolutely did curve fit it like very aggressively. So open in strategy analyzer tab. Save history true. And we're going to change this time period to be 2019. And does it still perform over 5 years? I'll be very surprised if it does. I'll be very surprised if it works really, really well over 5 years. Need to go and grab the Final Fantasy theme and stick it back in there so that when it's done it goes da 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 da. Yep, it does. It's probably not bad though. Oh, that's really interesting. Oh, what? Huh. I cannot believe it. I cannot believe that. That it's that bad. That it's that bad. This period right here is a little shocking. So I really, really curve fit that one, huh? Going back to this though, we didn't even look at the thing that we want to see. Because yeah, maybe we're curve fitting it, but the optimization graph might be able to show us. So there is this little bump here around this 0.3 area for some reason. But what I am seeing is that it's pretty random. Can you make it a reverse side? Well, yes and no. So like, you know, there's a bunch of filters on there and everything, but basically this FT threshold thing. Okay, so can I go? Let's go back and explain what it's trying to do. Let me try and give you like a really deep dive about what it's trying to do. Yeah, most strategies fall at 5 years or more. You're right. So what we're trying to, the main objective of this test is to try and make something that performs relatively well over limited time frames, by really taking on excessive risk. That's the main objective here. So I want something that, like, you know, you're going to win most of the time. I want it, or let me describe it this way. I want something where the profit curve, or whatever you call it, looks like this. Right? I want it to make a little bit, and then like all at once blow, etc. Okay, that's kind of the sort of setup that we're going for. Something that would be relatively effective at passing a combine, but is not profitable over the long term. Kind of prove that to people. Okay, so that's the objective. Okay. If we come, let's make a new chart here, and I'll show you what it's trying to do. So we're putting on a 1 minute chart here. And we have something called a Fourier, oh man, what is it called now? Fourier series analysis. Okay. And for the strategy, the Fourier period is 120. So let me come in here. Oops. This one? Oh, here I have one on it already. Okay. Fourier series analysis. Okay, so what a Fourier series analysis does is it is essentially a high pass filter. So think about it like, I don't know if you're familiar with like music production, but like a low pass filter would be like you only get the low frequencies. And a high pass filter is like you only get the higher frequencies. So most of the time in music, they use high pass filters. Like you want to filter out the low end because that just kind of is noise and makes your speakers less efficient. And the stuff that we hear and we're really interested in, we're using high pass filter, right? Okay. So what is that actually doing though? Well, like in a sound wave, you got stuff like this, right? This is doing this. This is like a sound wave. Okay. So the low frequency is this thing right here, like this, right? That's the low frequency that's getting. And then there's kind of this jiggle in between. Those are the high frequencies. Okay. So you can split them out. So if you split out, let's try this again. Okay. So one component is this. And what would we need to combine it with? We would need to combine it with this, right? This little part right here. So the low pass filter will pull this out for you, and the high pass filter will pull this out for you. Okay. So what we're trying to do is we're getting a high pass filter. So you're going to have the one part is going to be the overall trend, right? One filter is going to be the overall trend. One filter is going to be the larger, this would kind of be the midterm, right? And then within that, there's all this little stuff, right? So this Fourier series analysis essentially gives us a high pass filter of some sort. Okay. Now, one of the things that you'll find that's interesting is that sometimes you will have a move up or down that's quite a bit further than what would be suggested by the other oscillations that you're already having in the market, right? And so that's kind of what this shows, is you will get aberrations that go all the way up into the 2 and the 3 range. Okay. So let's just change this indicator to have the same period that because we were looking at a cycle period of 120. Okay. So what the strategy essentially does is it waits for you to get to one of these peaks. Basically, like, if this it would have to be much bigger, but this is coming back down and it crosses over the 2. Or this is coming back down and it crosses back up above the -2, right? And that's where it tries to take trades, okay? So that is the main entry signal criterion, okay? The other things that it's doing, though, the other filters that we have is we are filtering for the overall trend, and we are filtering for whether there is a decent amount of persistence in trend. So this is saying that the trend has to be, the R2 has to be over 0.5, and we are the overall trend is up, and then it will try and take along. That's what it's essentially trying to do. Okay. I have it set to like stay in the position. Right now I have that turned on. Okay. All right, so that's like the base setup. And then what we did is we came in and we said, okay, let's specify what our stop and our target are dynamically based on an ATR. So we're coming in and we're putting an ATR on like a 200 bar period sort of a thing to see like what is the average number of bars that it's moving at this particular time, yada, yada, yada. Right? And what we're finding, what this optimization graph is, I think, telling us is that doesn't do anything. That doesn't help. Now, it could be because we have one that is long and one that is short. So I want to do a few more tests here. If we change both of these to range short. Another thing that we can do is we can turn off the, turn on the stop and reverse. That usually helps the strategy, but let's try it. Oh yeah, so I was gonna say, because the reason you asked the question, was, can you get it to take the opposite? So what I can do is I can just say, instead of doing it when it crosses below 2, I can just do the opposite. And that's what essentially it does, and then you get it when it's doing essentially opposite signal. That's why I'm having it do it at 2 and -2. You can make the number that it's trading off of symmetrical, then all you got to do is change the number to a negative number to get it to try and take the opposite. It's maybe not quite taking the opposite because I'm using cross above and cross below, but it's close. I have no faith in trend strategies most days. Yeah, well, but it's not a trend strategy. It's a cycle strategy. It's trying to filter out the trends and take short-term trades based on the natural oscillations of the market. Now, can that work on a 1-minute chart? Probably not. Probably not. But what we should be able to do, is get a strategy that appears to. Now, I thought that I was really close there. I thought, because what did we do was we kind of optimized it over a 1-year period, and it looked like this, right? But then the larger graph was actually right? And what we actually want is something that's kind of more like this, right? And when we optimize it, we're only seeing this part. That's what we really want. So I'm not necessarily expecting to create a profitable strategy here. I am of the opinion that if all I'm doing is taking a single time price data series, that it should be pretty difficult, if not impossible, to make a strategy that is consistently profitable over a 5 to 10 year time period. Now, when you get over into swing strategies and you're working on daily bars, then there are some things about this stuff that you can make decent trades from. Okay. And that's where momentum strategies and mean reversion strategies come from. And these are more useful. But I'm trying to, sort out. Now, let me tell you something about the trend thing. I talk about this all the time, but there's a couple of new guys in here, so I want to make sure that I point this out. The reason that a momentum strategy works is not because it's a predictive signal. The reason that a momentum strategy works is because the outcome distributions have fat tails. So if you're able to set things in the strategy in a way in which when you win like Mondo big time, right? Because if you can set it so that your winner is like 100 times your loser, okay? This is like with taking risk. Like if you want to be a small business owner, like you got to take risks. You got to take risks because the whole thing is that you can fail and fail and fail and fail and fail. And then the one time that you do well, you make hundreds of millions of dollars from it. Then all of a sudden it makes everything else that you did worth it, doesn't it? Right? On a day trading basis, there is a limit to how far it can go in a day. And that's why momentum strategies don't really work for day trading, but they do work for momentum trading because for like portfolio management, because now you're trading across a variety of assets. So you can always find an asset that is really actually trending, and you can hold it for several months and or years and really get something that is effective. How much is this strategy that has a 12% expectancy at a 1-to-1 risk reward worth? Oh, I think it'd be worth way more than $1 million. I think it could. So, but you would have to calculate it actually, right? So like it would kind of depend on what it's doing, but basically what we could do is we could, every time that it trades, measure the amount of volatility in the market and the amount of volume on the market. Use some sort of a filter to take a data point about what that is, and then we can use something like the Kyle model, taking into account the square root law of market impact to optimize the size that you trade on the edge, and you actually want to take a percentage of that, so maybe 50% of that, right? And then you could sort out how big you can actually scale the strategy up. And then you look at that over like a 10-year period, and that's how I would value. Like if I was going to sell it to somebody, that's how I would calculate how much to sell it for. But I don't think I've ever found anything that's anywhere even remotely close to that. Did that not actually change anything? The range long and the range short are the same. That's why. Okay, so that answers that. Next question. Okay, so the cool thing about my strategy is it's always taken at a specific minute of the day. So yeah, I think that there's a problem with that actually. Like I think that that's actually a very good way to take a trade. Like that's a good signal. That can be a really good signal. Like, it really can. But the problem that you get with that one is that you get a limited data set from it, right? Like from that data set, the most samples that I can ever get in a year is the number of trading days in a year, which is something around like 250 or something like that, right? So you might not have enough data points to really actually verify that the results that you're seeing are statistically significant. if you've done it over 10 years and it has a 12% edge on that and equal risk reward, then it's probably still worth trading. With the acknowledgement that there's a limitation on how effectively I can actually test it. That makes sense? So I have on here, I got rid of these. I don't know if these actually made a difference. But we're going to come in and we're going to use the daily ATR period as a percent. No, I want it to be in ticks. So we had it as a percent because I wanted to have it like when you're over X percent, the ATR is over X percent, then don't trade. Right? That's what this is right here. But we're going to change it to ticks. Yeah, are you the one that showed me these where it was like you showed me on Discord because it was like on a currency, right? Yeah. And the other problem, because the other problem I remember with that one is that like you only buy, right? So I'm a little bit. So there's one side of it is, okay, you have a decent historical track record. How confident can we be that, oh, well, okay, but you're doing something similar to them then, okay? So the first thing is you have something with a pretty decent historical track record. What are the chances that it continues to follow that historical track record, essentially, right? One of the things in these back tests is you get this probability bit, which is like what it's basically doing is it's saying, how often do you actually get that? So having a high probability, that's one thing that really helps. Okay. And having a high number of samples, that's something that really, really helps. So with something that only takes one trade a day, that's to make it like statistically significant, kind of hard. Especially if you don't have a high probability. Because if you don't have a high probability, that would be something like you have a stop and target that you take, and it hits that stop and target most of the time. But if you don't have a stop and target, then you can have a situation where it doesn't work that day, and you take an enormous loss, right? And that's going to be the thing that's going to destroy a strategy like that, is there's going to be a fat tail that you can't see because you don't have enough data, right? I don't know if you could say that, because really you're doing 3 strategies a day at that point, right? Like if you have 3 separate times that you're taking it, right? I kind of feel like each one of those is a separate thing. But a time of day based entry can provide some edge, because there are large institutions out there and they might be doing something at the same time every day or at the same time every month, and you might be picking up on that. So like there can be some real edge in that. It's just that like I'm a little bit skeptical about the long-term efficacy of like a portfolio that only has one of those, essentially. Okay, so what was I doing here? Also, I would be really worried about it on a currency. like currencies kind of end up being a different beast. Yeah. But like the thing is, so with currencies, you know what? I've never really gotten into this sort of thing, but I've definitely seen some things from people. Oh, it's an NQ strategy. That's maybe even worse though. So with the currency strategies, there's these things where like they'll do this sort of a thing, and there's like this weekly cycle that people know about, right? With NQ, you got a different issue. So is the strategy only buy? Is it you always buy at the same time of day? It can be a short or a long. Okay, that's better. So one of the things that a lot of people do is they'll let the algorithm only buy, and then what you're actually picking up is the bias of equity indexes tend to turn up, and there's not any actual like edge in the strategy, right? ZN keeps falling. It is on the downturn here. Oh, actually, that was a significant drop. This might not be granular enough, but this should only give us like 100 or 200 iterations, right? Oh, there's a bug in it? Right. Right, because I commented that stuff out. This right here. Maybe. I mean, if you have like a especially for a signal like that. Okay, so like here's one of the things is that if you have backtested that, like if you have backtested that and over a 10-year period, let's say, I think for the kind of signal that you're talking about, like let's do 10 years, and you're appropriately accounting for slippage. Because on NQ, man, that thing is a slippery beast, right? But if you've appropriately accounted for slippage, you could start a fund, potentially. The issue that I think that you're going to find, though, is that the performance of this strategy on its own might be profitable, but might not be good enough to actually entice other investors, right? So then you'd have to look at like what is the Sharpe ratio of it and things like that, because there are other funds out there that have Sharpe ratios well over 2 or 3. So like, why would they invest in your fund when they can do that, right? So then there's that other issue. See, for us, if we can, because to be honest with you, I feel like that a lot of the motivation for me, and maybe for a lot of my other viewers that are here and are doing day trading, because we kind of understand that like there's a limit to what you can actually do with day trading. Like you're not, it's very difficult to find success with day trading, right? And I feel like that a lot of it is just you want to be involved. You know, so if you just want to be involved, hey, if I can get something that's at least profitable, and it has, you know, a Sharpe ratio above 0.5, then like that's like a really great accomplishment. But if you're going to start a fund with it, then you have to do, there's some other issues, right? This is why, for instance, funds almost always involve managing a portfolio, because it's in having, okay, so like you're trading NQ, right? And NQ does this thing, and it's like all over the place. I can't draw right now because the back testing is so slow. Okay, that is different. Let me finish what I was saying. Okay, you have NQs doing this, right? And then you have this other thing that's doing this, right? Okay, so like what I want to do is, hey, they could just go and buy NQ. Why don't they just go and buy NQ? Well, because sometimes NQ goes down and it's a pretty big drawdown, and that's kind of painful. So then what do I need? I need something that like does the exact opposite of NQ. I need something that is that gives me diversification. That basically like the performance of this thing is drastically different from the performance of this thing, right? And then you have all of these different components. So if I'm trading all of these different instruments, right? You know, and NQ is like the most volatile, then the most that I'm ever going to make is what I'm going to make on NQ, right? So it's like, if I have a strategy that only trades NQ, then it better be making more than I would make if I just bought and hold NQ. That is, if I want other people to invest in it, right? Or you take the route that most funds do, and you're going for diversified performance. And how do you get that? You're trading a wide variety of instruments. So now when you have something that's trading a wide variety of instruments, all of a sudden you can get something where the performance of it is very drastically different from equities. And especially if you can get something that has far right tails, like momentum strategies do, then, you know, when the S&P 500 is down, that strategy like way outperforms, right? So your issue is not necessarily that you only have 1 year track record of you trading it. Your issue is, does the performance itself actually going to be attractive to outside investors? Okay, so the performance of this was drastically different, and frankly better. Probably because it's taking much larger things. So let's see here. It's actually taking targets bigger than the stop. Really? It's actually preferring the hold it for a long time trade. I do wonder, maybe the reason why I'm not getting it to perform the way that I want it to is because the 4-year period that I'm using here is way too big. But when I come into the optimization graph for this, so for the stops, that seems relatively non-consequential, but the targets, it likes the targets. Now I'm only doing it by 0.1 of the daily average true range, so I could probably make it a little bit more granular than that. But that kind of suggests to me that that is a much better method of determining where to set my stop and target, is the daily ATR and not something else. Yeah. Another thing that would look at it. Well, so you're saying this strategy just won. The other thing would be like, how much is it actually making from it, right? Like if you're coming into NQ and, well, let me show you. Should we do this? Yeah, let's do it this way. NQ. So here's the NQ. Okay. No, you need to tell me in ticks. Number of ticks. What is it making number of ticks? 12 R's. I don't know what 12 R's are. Unless you're talking about R factor. Get rid of the Fourier series analysis on here. I don't think we really need that. Just gonna take up room. So like this is the average range of a 1 minute bar in NQ right now, right? So it's saying that on average it's doing 10 ticks, right? And this right here is the halfway point. What it's saying, so one of the things you got to keep in mind is that this is actually an exponential. So if we were to actually chart it like on a normal scale, it would be like this, right? Then you wouldn't be able to see anything. So it's we've used log. I think it's using a log scale. Okay, this point is where they're equal. So basically, it's saying that the value of all of these bars added up is equal to the value of all of these bars added up, right? So if it is on NQ and it's making less than 30 ticks, there's a really strong chance that it is just noise. Once you're making more than that, like if you were making 60 ticks on it on average, then I would really be like, whoa, wait, what? All right. NQ is the best symbol for bookmap traders. Well, that might be. You know, that's a kind of interesting point that, you know, the Vista charts are going to be more useful in a really illiquid market. Because then in a really illiquid market, you can't really see anything going on the inside bids and asks anyways. And so my main complaint with the bookmap charts is not really relevant anymore. Anyways. Oh, so interesting. But it doesn't, the stop doesn't seem to, but I'm only doing 0 to 1. Making 70? No way. 70 points? Not ticks, points? Now I think you're fibbing. I don't think that the NQ even... Where did the chart go? NQ. 1 day. I guess 70 points isn't that unrealistic. That's 25% of the average true range. Interesting. Okay, so you don't have that problem. I guess the thing is I've seen many people that come in with, well, I just take it at the same time of day every day sort of a thing. And then, like, they don't last with it for some reason. So those are some of the caveats with it that I've seen people come across, right? No, it's not like that. No, see, yeah, but it is like that. So, like, the problem that you're going to have, right, is, so you've been doing it for a year and it's going okay for you, right? Once you have a little time period where you've done really well under your belt, like, it messes with people's heads, right? It kind of affects your ability to analyze it objectively. There can be problems with what you're doing, but you may actually have something. You sounds like you've at least passed the obvious hurdles. You've at least passed the obvious hurdles. Do I need this chart anymore? I think I'm just gonna close that one. Okay, so the issue that I got here on this thing is that it's favoring bigger targets. So with the way that we've been doing this, I think to get it to do what I want, I would have to change some of these base parameters. So now it's kind of like a swing strategy. So let's just see what we get if we do that. I would actually, let's not do it that extreme. Let's just go to 5.5 to 5.5. This will just be kind of a sanity check. S&P 500 having some interesting movement this morning, but I guess nothing out of the ordinary. It's just there's kind of a drop before the open, and then since the open, they've just immediately recovered it, and now they're testing that and coming back down. So that's a little curious. Monica's here this morning. Good morning. I think this is going to be the last one that I do here, by the way, on this. Yeah, so now that I'm thinking about it, midnight, that is really your issue. So if you're taking 25% of the average true range in NQ, then that's not really going to be very attractive for a fund, right? Because they're just going to be like, oh, wow, I'm just invest in the index, right? Oh, so interesting. Wait, what's this? Of course. Of course. Because once you get over 1% of the day's range, probably not taking a ton of trades, though, at that point, is it? Yeah. Yep. Interesting, though, that this seems to, well, it does better with a longer target. It still kind of suggests that the setup that we're doing isn't really helping, right? So let me go back here. Point 0.01, 0.3. We're just going to use the default for this. Okay, so that should give me 30 times 30. Okay. No, how are you going to make a 70% annual return on only taking that percentage of the day's range? What did it make that year? Well, no, because I think that what you're doing is you're using the leverage, right? Right. So yeah, if you're coming in and you're using a future and you have leverage, then you're making more on a percentage of your portfolio, right? But that's not the way that you look at it as a fund. So you would have to take, like, how much did you actually make last year and convert it into what if I was just trading the index itself instead of the future? Or conversely, probably the easier thing to do, because it sounds like you back tested it, right? The easier thing to do would be create a strategy that just buys and holds. Uh-oh, I'm running out of space. I know where that's all being taken up from, though. That's actually not as much as I thought it was going to be. 70 gigabytes just from my DaVinci cache. Should probably move some of my my videos over to the archive as well, but I can do that after the stream. Oh, my wife got the actual camera set up again. That's cool. Didn't realize when she handed it that she handed me the video one instead of the audio one for the kids. And I'm disappointed. I thought, hey, well, let's go snowboarding today since it snowed. But apparently up at the ski resort up north from me, it didn't snow. Yeah, in fact, it is not... Oh, well, now that's interesting. Here's something that says that it did snow there. But it's really foggy up there. It's really foggy. Yeah, see, that shows that it snowed. I would have to take chains if I was going to go up there. That suggests that it did snow. I don't know if I actually want to go or not now. I'm torn now. Probably did too many iterations there with that. You looked into opening, yeah, you know, it's been a really long time since I've done it, but I have looked into opening range breakouts, and, you know, it kind of has, like, many of the same kind of issues. Like, it seems to work a lot, but then if you really include enough data, it's not an effective strategy, you know? No, but yeah, I get what you're saying, Midnight. But like, if I'm in NinjaTrader, like if you're backtesting it in NinjaTrader, right, and you just say I'm going to use one contract, and then how much did it make, right, and then make another strategy that is just one contract that just buys and holds it through the whole time period, and compare the two of them, I'd be really, really shocked if your strategy ended up making a higher overall return than the buy and hold one, because you're only taking a quarter of the day's average true range. And while it does win most of the time, it's like 60%, but like we have an update 55-60% of the time. So it would be really hard. Granted, you're taking 3 a day, so maybe with 3 a day, and if they're each taking that much, and they each won, maybe you could get close. But yeah, my backtesting of opening range breakout is that it's basically a break-even strategy. But there's also all of these kind of weird edge. So the issue that I find with that one is that people do these things where it's like, okay, so there's going to be this opening range, right? And then when it breaks out of that range, I'm going to go long right here, right? And then, okay, so that works. So then it does this, and it breaks out of the range, and then it does this, right? Okay. So on this one, do I scratch it, and then I take this one short? Maybe. What if it does this? right? Now it's right. So like you'll create new rules to deal with these new novel situations that you have, and they just keep, you know, the market finds a way to screw it up, essentially. But the problem is that when you're looking at opening range breakouts, you only see this one in your mind, and you're not able to go and backtest all of them and see the pitfalls. And so then you get into this big mess of trying all of these different rules and ways of trying to mess it up, or you know, to sort it out. And that's where it's like, well, I can backtest all of those, but what's the one that you want to do, right? Do we all agree on like what is the correct strategy for this? Because if I go in and I do one and it doesn't work, and then somebody goes, "Oh, that's because you're doing it wrong." Okay, so what's the right way to do it? Like, because every way that I backtested it, it didn't work, right? You think we should get long? Why would he be saying? Why would he? Okay, that's way more interesting. That's way more interesting, guys. Oh, and there are some that are profitable. Okay, that's way more interesting. I don't really see the case for going long here, D. But I overall, I don't know. I've said, I don't think it's worth trading. If you traded it, I guess you could have probably taken it from here to here. That's not a bad winner. And this one is worth taking to a new tab. So the Sharpe ratio is a little bit below 0.5 now, but we get more trades. 0.76 R factor. Okay. Probability is not very high, so I don't like that. R squared is 0.85 though. That's pretty good. All right. Oh, just kind of want to come in that. Oh, okay. So it picked it up from one period though. Oh, what were the numbers that it picked? 0.16 and 0.11. Well, okay. Maybe that's okay. I really don't like that it made it all in that one spot though. Ooh. Okay. That actually looks pretty random. Yeah. Okay. Well, I don't have much confidence in this one surviving the 5-year test either, but it might show me the graph that I want. It might show me the graph that I want. There it is. There it is. Very interesting. So this one is not as extreme as I want, though. I think what happened on this one is that we over optimized it onto, you know, this right here. Oh, why did it open up twice? Oh. So only a few they were actually profitable too. It's a little bit like, So are there some ones that we can like obviously take out though? Yes, because it seems like somewhere around here. So I think that I can start with the stop at more like 0.1. 0.1. Leave the target alone. I'll make the increments a little bit bigger. And I don't want to use the whole period that I have, but let's just do from 2022. And maybe that will do better for us. Maybe that will help us filter out that, like, you know, there's this period where one certain risk reward works really, really well for some reason. Then. But I don't want to do the whole 5 years because I still want to be able to have something to go back and verify it with. Is the opening range formed due to algos taking their positions, or is it? I think that it's just random. I think that, you know, you would be able to define it. So, okay, so let me explain it this way. In the S&P 500, the vast, and I mean vast majority of the volume occurs within the first 30 minutes and the last 30 minutes. The closing auction is a really big deal because that's where a lot of really big players, they get the liquidity to do things at the closing auction. So the closing auction is a really big deal. But most of the action happens in that beginning part, right? So if you think about it, when are you going to have the most volatility? Right at the very beginning, right? Which means that it's a lot more difficult to form a new high after that opening range, right? Like, oh, you don't think it's worth automating? You haven't automated it? This whole time I thought that it was already automated midnight. If it based on your description of it, it should be easy to automate it at, and it's absolutely worth automating, and I would do it for you if you want it. Kind of comes back to that thing. It's like, what's your goal, right? Like, if you want to do it as a fund and you want to sell it to somebody or something like that, then, well, I'm really skeptical that it's going to work, but okay. But if you're just doing it for you, then that's different, right? If you're just doing it for you and it's futures trading and it's profitable, I think it's worth doing, you know? Granted, that might be kind of a boring strategy, but I don't know, if it makes money, it makes money, right? So you're still like, the numbers you're giving me are kind of like, right, but I don't know what you're, so like you make if you have an account, like if you start with $1,000 account and you made $300 on it over the year, then like cool, okay. And then do we minus out the the data subscriptions and all those sorts of things from it, right? There's those sorts of things, but 30%, okay, that's cool, but you're using leverage, so might not scale to a fund. I'm like, why is this going so slow? But then I'm remembering, oh yeah, because we're doing 2 years. Theoretically, it should single in on the same general, I know. Okay, so here's the question. So you get this issue if you come in and you're changing all these parameters and stuff, you can like overfit the algorithm to something, right? But then there's also this other thing that's like, okay, but when you are doing optimization, is 1 year not enough? Because you're going to optimize it towards just one type of market, and ergo, you're always going to screw it up. That like, if you optimize it towards a 5-year period, then that's a little bit better. But then you have to have a second 5-year time period to run the test against. You have to have an optimized period and a test period. And I don't think that this goes back that far. Oh, maybe it does. I don't know. But then if that's what I was going to do, I would probably want to do the optimization over the old data. You know what I mean? Okay, what was that? Ninja's gonna chug a little bit here. Okay, so it was in the treasury. Come on, finish up here. There we go. Okay. But really, most of them are losing. Most of them are losing. But what did this one target 0.2 and stop 0.22? Huh. So an equal risk reward. Oops. $19.19. Really admire how you automate backtesting, spend hours setting up charts in Sierra and manually backtesting. Dude, don't waste your time with that, man. Yeah, you should consider teaching others how to streamline this. Well, but I mean, I have videos about this, though. So, and let me tell you something, man. It is not nearly as hard as you think. Okay, wait a second. Yes, that's more like it. That's more like it. I actually would have been okay with it not being like overall net profitable, but what I want to see is periods where it does really well and periods where it does absolutely dismal. right? That's pretty good. That's maybe worth doing what I want to do with it. Very curious to me that the daily ATR ends up being more effective. But yeah, like setting things up and manually backtesting, that there's two problems with that. One is that humans tend not to be very objective about it. And number two is that you just can't backtest enough data, you know? So what did we get? On this one, we got 5,000 trades. 5,000 trades in that data set, right? So I would prefer to see 10,000, especially with the way that this performs. I wouldn't be surprised if over a large enough data set, there ends up being a point where it goes like this. It'll look like this and go goodish. That could totally happen, right? Especially when you look at this thing right here, right? That's like, oh my gosh. But you know what's going on here? This was the retail frenzy. So very interesting. Either way, it fits our qualifications. It fits the qualifications that we set for Degenerate Gambler. We wanted something that, well, actually, does it fit the qualifications? Currency and net profit and period monthly. Yes, it does. I need to make something. I wonder, is it possible to make your own graphs? Change it back to daily. Okay, that's a problem. That's a problem, actually. It wouldn't work. Well, but we can do it. Yeah. So we could get close. So the question is, okay, can you run this on a combine? Right? Well, it's taking days that are like crazy. Like there's almost a $9,000 day where it loses $9,000, right? So that's kind of a problem. You would lose your combine doing that, right? But if we were to use a micro contract instead, so we just take 1/10 of all of these, then yeah, you would have to set a line right here. Which is not too hard for us to do, by the way. Not too hard for us to do. As soon as we're getting to 500, then you stop trading for the day. Put that filter on it. Would probably, now when you come over to the drawdowns, right? We basically have to avoid a $20,000 drawdown. Yeah, and we're okay on that part. But then over here, you have to get, like, how much do you make 30,000 off of this, right? It's kind of rough. It wouldn't always pass, right? Like if you were doing in this period where it's 35, or if we just change this period back to monthly net profit, okay, and it never makes $30,000 in a month. So it wouldn't pass a combine. There is a period, this period right here, it would probably pass it over several months. Ugh. Man. When you start looking at it through that lens, you realize how absolutely bonkers the combine targets and everything actually are. Okay, but you could just trade a full ES contract, I guess. Or maybe you could say half of this, but you know, you wouldn't always pass it, but it would be enough. It would be enough to get people to want to do it, I think. Like there's some of these periods where it would pass the combine in a day. Oh, that's so interesting. You know what we should do? Or what we could do. Yeah, I think I have to be on a daily. Oh man, this would actually be way more complicated than I'm thinking. But it, like basically, okay, so like if we split the trades out, you take all of the individual trades and stuff, and then say, okay, when would you have passed and failed combines? But then there would be this whole thing about it would depend on when you started the combine, right? So then we'd have to go in and say, okay, so here's a period of profits that fits, and here's a period of losses that would break you no matter what, right? So anytime that we have a drawdown of 2,000, right, then you start a new combine. Oh, so very, very, very interesting. Now we can also, though, come in to look at some of these other things, like yeah, it is too leveraged, but you could trade it with like 5 contracts. Not only that, but you could trade it with like 5 contracts that have multiple targets and stuff. Well, okay, we could mess with that another time, but I want to look at some of these things. There's some of these that are kind of like, because what we could do is we could give it a max volatility filter. Let's do it. Because I already had that set up, right? So I have volatility ceiling set to 2%. Oh, so for that we can't do it like that. We have to go. Make a new parameter for it. And over here, volatility percent ceiling. Okay. So this is probably going to change the overall net profit on it, but we don't care. And what is the ceiling to? Okay. Run. So basically it says if the volatility is if the ATR is above 2%, then it stops trading. Oh wow, that increased the Sharpe ratio so much. It took it from a Sharpe ratio of 0.9 to a Sharpe ratio of 0.25. It's a little bit better. See that now there's all of those big ones that are over there. They're gone. See what I did? And if we decreased it even more, like if we said less than 1%, then it would only be grabbing these. That's what I wanted. Oh. Okay, so let's come back. Copy these bits. Daily ATR period 14. 4-year period. Short ATR period 10, long ATR period 200. We can get rid of those because we're not using those anymore. Let's see if that broke it. I got them all. Oh, yeah, well, we need to get rid of that one, sure. Oh, of course. This is the other method that we had in there that we're not using. Okay. So coming back. Daily ATR period 14. 4-year period 20. FT thresholds is 2. Oh, did I not get rid of the things for it? Long and short ATR periods. Okay. I think that we don't need that anymore, I think. That could change a few things because it might, there might be an earlier trade that it could catch now. Okay. I'm trying to get the defaults to be the same as this. 22 moving average period. I'm going to order them in the same order as well. Moving average period. Why is the R2 period? Oh, there it is right there. Durr. R2 thresholds. Stop. Target volatility ceiling. $14.22. 120, 50.5. Stop and target. Well, it has target 0.2 and stop 0.22. Whatever. Volatility ceiling right now, I have it set to 1. Okay. Now I want to add a new thing. Volatility floor. It's less than volatility floor. And print too cold. So this is where 1 was too high. Okay, so now we get the floor. 0.5 and 2. Yeah. Okay, that didn't actually take that many out, though. It was only about 100 trades. Oh, that's interesting. Wait, so what if I had the floor, like, really higher, though? Yeah, that's not as good. It takes out too many. Same on this one, like if I go a little bit higher, 3. No? Interesting. Oh. Oh, wow. Yeah, total net profit is like way higher though. You're taking on substantially more. Now, why is it that the probability on the long trades is so low and the probability on the short trades is so high? That's a little bit. And like the R squared is saying it's 0, but then the R squared over here is almost 1. That's okay. You know what though? If you told it to only take longs, because it is, you know what? We probably can get away with that. So I like the better Sharpe ratio. Ceiling 2 and floor 0.5. .27. And then, yeah. Wait, was it net? Oh, okay. Like you made a little bit from the long trades. We might be able to. So I think for an equity index. So the issue here is you know, the market is going to be more volatile and maybe a little bit different when it's falling, essentially. So we might want to do something where we have additional filters on these because the market's going to be more volatile when it's selling. But if we just come in and say, you know what, like, let's only buy. Let's only buy. Because it's an equity index. There's some real problems doing that. But it was successful on both signals, and we're just filtering one out. And this isn't necessarily for like what we want, a profitable strategy, as much as it is. Oh yeah. Curve fitted, maybe. And go back as far back as it'll let me. Come on now, it's not take that long to download the data, does it? Maybe at I'm thinking about snow. Well, this is going. I'm thinking about snow, and I'm like, how come they don't say how many, that there was any snow drop overnight? Well, maybe the employees aren't there yet. They don't update that until they get there. I don't know. Well, no, but there are people. There are definitely people on the mountain like way early before things open. So that's a bad theory. Bad theory. It's still going. Ah, yeah. I don't like that. Like all of the sudden after the 2019 market, then it starts working. I mean, I could see some good reasons for it to start working there. But it does make me a little bit skeptical. But I don't believe in it either. I don't know. Like, again, the whole thing was not to make something that I'm gonna trade per se, as much as it is, let's put it on automate, right? So, oh, you know what? I did all of that with the one turned off. You can get rid of these commented outlines too now. So we're certain that that's what we want to do on that. Okay, a little bit more extreme. Did not like 2018 for some reason, huh? But in terms of the experiment that we want to do with it, I think that this algorithm is fulfilling its purpose in life. Now, I got this other thing, which is like an inside bar sort of a thing. I don't know why I added this in here. I'm just going to delete it. It is really just saying only trade an inside bar when we have low volatility. It wasn't working very well, so. Volatility ceiling is 2, right? 2 and 0.5. So that's good, because then when January comes along, we can start running this algo. Don't let me forget. I guess I need to put something like, I have like this little board that I put sticky notes on, but it doesn't sit there very well. Need like a little stand. Need a little stand to put it right there underneath the monitor, and all of these things that I need to remember. Start the algo. Well, I can go find one after this. Yeah, like 10 minutes left. I feel like this was a big success. I was getting really frustrated with it there for a little while, but it's one of the problems that I have is because I'm so ADHD, I'll get really tunnel visioned on the thing that I'm doing there, right? And not be able to like zoom back out and look at the big picture and like, okay, what are we actually trying to do here though? But eventually I got there, right? So, and I do think that I did a good enough job of like, so I think that there's a pretty high probability that the algorithm that I just created is overfitted. But I did use a couple of methods there to kind of limit the fitting to an extent, right? Like, it is a relatively simple strategy. I'm not really, it's interesting that one came out with an equal risk rewarded, which is also really interesting. But could probably come in and make the stop like twice as big and see what it does. But let's just put it on a chart on Monday and let it do its thing. And yeah. I'm looking at it. Now, the other thing that I wanted to look at, even though we don't really have any time, is if I can figure out a way to fix our watermark. So there's this kind of bug here with our watermark. When we come over to like a volume profile, that it doesn't see the center of it, because basically when it has gotten its properties to try and determine where it should do that from, it's not, the values aren't there yet. So here's the watermark. Oh. Okay, so this is maybe easier than I thought it would be. Well, it looks okay to you. It will only show the bug like on the first startup of it, like you close NinjaTrader and open it. Actually, let's set things up so that we can duplicate it first and then fix it. And then, okay. So to duplicate it, I'm going to save my workspace here. I'm going to move over to the develop workspace. And then it looks like I got a ZN over here already on it. I'm just going to close that one. I'm going to open a new chart. I'm going to try to put it on ZN, but I'm going to put it on day bars. Okay. Here's the day bars. And then we're going to add the watermark. Okay. ZN. Okay. And then I'm going to close this back up. Workspace. So then it's something that happens like when the chart first loads in NinjaTrader. So it should be able to, like, if we close NinjaTrader, count to 5, 1, 1000, 2, 1000, 3, 1000, 4, 1000, 5, 1000, restart NinjaTrader. Maybe I should have it over on this other screen. Is it a problem with it being full screen? That's curious. I can't get it to do it now. It doesn't do it. Wait, that's so annoying. Okay, well, I'm gonna make the change anyways. I think I know what's going on. Is I think that what's happening here is in this method right here where we update the layout. Yeah, we figure out the metrics essentially about where it's supposed to be. No, it's, if I opened up my regular workspace, then you would definitely see it. I could definitely make it happen, I think. Test it, because it happens you see it at the beginning of every stream. If you go back to the beginning of, well, maybe not today's because I left NinjaTrader open all night, but if you go to like 2 days ago and you look at my things, like the first thing is like I have to click in there somewhere first before the update, the layout goes to where it's supposed to go. So I think that if I come in here to like on render, and I say something like _V. Okay. If _V dot X is less than 0, is, well, let's say less than 10. Update layout. I think that's the fix that I need to make. So then it will do this thing where it's like, oh, it says that the vector is small. That can't possibly be the case. I need to fix it. Yada yada. That's kind of like there's a problem with that, because then if there's the X is too small, like if I make the watermark be like almost the whole size of the thing, then it would have an issue. Well, it wouldn't have an issue, but it would just be updating the layout like all the time. But I can put that in there. I'm going to close this one. I'm gonna save that workspace. No, let's just close out all that. Save that workspace with nothing on it. Come to this backup workspace now. And see if I get the issue. I think it may actually have something to do with like, oh, maybe that's what it was. Maybe that's what it is. Maybe I can do. Okay, I have a new theory on how I can duplicate it. Maybe it only happens when the chart is minimized. Yeah, let's see. It didn't do it there. Didn't do it there. But maybe that's because I fixed it. Let's try this again. Do it on daily bar. We got our daily bar. Watermark. Add the watermark. Minimize the chart. Oh, you got to go back and unfix it. Go back and unfix it. Unfix it. Build. Minimize. Close NinjaTrader. Save the workspace. And reopen it. Where's the link? There we go. There, reopen NinjaTrader. Okay. And let everything open up and then look at the chart. That's so weird and frustrating. I do not know what causes this bug. Oh, man. All right, well. We'll just, you know, maybe it's something else. Maybe it's something else. I'll know if I go through all of next week and I don't encounter it that I fixed it. Minimize that. I'll try one more thing, and what that is, I will close it the way that I normally have it closed. And then open it back up. I'm just thinking about our little algorithm that we fixed up today. I guess the first big hurdle is going to be we run it live and like does the live match the back test, because that's sometimes something that we screw up very, very often. Maybe it only occurs during the... Has nothing to do with the fair value gap. Where are you bringing that up? You were here the other day when we were working on that, though, weren't you? Daybot? Okay, so it didn't do it there, so... what'll happen when you have the bug is the watermark will be like over here, and you have to touch the chart for it to center correctly. So why basically I just told it, if you're trying to do it over here, if you're trying to do it over at like 0, then something's obviously wrong and you need to recalculate the layout. So, oh, you're just joking? Were you here when do you guys, I don't know, I can bring that up again now. I might as well. Here just before we go. I made one. Let's use ES. Minute chart. Where did it go? Did I not? That's a little freaky. Weird. Doesn't like it now all of a sudden. I'm like creating a chart. I'm doing it on the other screen. Coming in, I'm creating a chart. ES. Okay, here's a candlestick. I click OK. Oh, now it does it. Now it does it. Okay. My gosh. I don't know what was. Maybe it was because I had the control center on the other screen. But it was just like they're not showing up. There's probably like all of these charts over on some other screen that are like there forever now or something. Okay, fair value gap. Oh, it doesn't like it. What does it not like about that? I found a bug. I tell you what, nothing pisses me off more than like when you try and add something in and now all of a sudden there's a bug with it, huh? Oh, how come this didn't show up before? That's so weird. If current R is less than 2, return. There we go. How did that work before? That's so weird. There you go. There's your fair value gaps. And see how it draws them until they get taken out. Pretty cool, right? Makes you want to buy my indicator suite, does it? Maybe just a little. No? I give you that other algorithm. Let's run that other algorithm for a month before we tell people, oh, you can use this. Problem with the better value gap is that they get drawn too often. Of course, you can come in and you can say, well, you know what? So, this answers this question actually today. Basically, we need to know what the daily ATR is, and judge the gap. Judge the gap based on a daily ATR is what has to happen. Yep. So, let's come back over here to Degenerate Gambler and just, pull that out like that. In the configure and the data series. Here we do this. Else if state equals state dot data loaded. Instantiate the indicator. And gap should be something like 0.01 or something like that. Is gap an int? Probably is. W. So for this to work now, I have to change this to be more like a 90-day chart or something like that. There we go. But so like if I think that one is too small, don't want it. Then we come in and we say to gap, maybe we want 10% of the daily's average true range, and then they disappear. Ta-da. Interestingly enough, these ones do not create it. Oh, those ones might. Oh wait, is it doing something? Is it like not like something now? Oh, let's go rid of that stupid debug thing now. Dum-ba-dum-ba-dum-ba-dum-ba-dum. Oh, because I did 0.5, not 0.05. There we go. There may... Oh, okay. I like it. It certainly does ones where it's like, I feel like that there should be, yeah, like, well, shouldn't that be a gap, for instance? Well, maybe if we did it to like, so if we change this to a 5-minute chart, then we would get more of them, probably. That's not a gap right there? Come on, really? Okay, I don't know what's going on with that one. It should be drawing a gap there for sure. There's a smaller gap there, and there's a smaller gap there. Let me double check a few things here. It's ticks. I need some way to say there was a thing, but it didn't fit the gap or something like that. Let's just try this. If bars in progress equals... Nah, I don't do it that way. We'll just print out. Print this thing. Price. Some things about the way I did this that I'm kind of questioning here. Not that it would change the output, but like just some like low-level programming decisions. These two are just the opposites of each other, right? I'm going like way over, but it's sound asleep. I see. I see why it's like that. So that one should be a gap, but that one shouldn't. Okay, one more thing we got to add on here. Current bar plus. Here's the output window. Clear that out. And the F5 on here. And the one that I think should be... Oh, I need to add something else. Need to add free current bar debug. Okay, so it's around bar what? To turn on the cursors. Bar 17193. 17194. So it says that it's a min gap of 1.775, but the space down is 8.5. So why does that not draw a fair value gap? Gap up, volatility times the gap times the tick size. Let's change that. So read and ensure that it's really going the same way. Is it there? Could be a different bug. Could be some other bug that it's like completely... Oh, there's the kids. I guess we're done here. 17194. Heading cap. Oh, really? So what is causing it to get filtered? Oh. Oh. Very interesting. Very interesting indeed. It should be saying that I got retraced right here. Oh, this is really weird. So there appears to be some really bizarre edge case where it's not setting the bar that it's retraced to correctly. Maybe it's because I'm sending it to the wrong direction. That wouldn't make much sense either, though. So it's an up. One 7779. Okay, now I'm gonna show you how to debug something really crazy here. So I basically have to see it at this point. So I'm gonna come in here and I'm gonna say if current R. Oh, actually, I can just say if state equals state dot real time, like that. I'm gonna build that. I'm gonna come over here to Visual Studio, and I'm gonna say in this fair value gap thing, you know, if that triggers, gotcha process, Ninja Trader, No? Well, I can wait till the end of the bar and then it will definitely do it. Or actually, I could do this. Now let's change it. The right window. Oh, it's over here. I have it over here on the screen. Oh, here he goes. Did it. It broke. Okay, so now I should be able to go into gaps. Let's see here. Probably should be like all the way at the very end of the... Oh, that's not gonna work. Oh, okay, here we go. 17194. 17193. R retraced 62. With the what? Okay. How is that working? How is that happening? Okay, so I see what's happening now. Is it saying on bar way over here for some reason? It's finding that collection and going, oh, it got crossed over here. Why would it be setting it to that? I only have one data series on. Oh, I know why. I know why. Oh my gosh, Seth, you're so stupid. You're so stupid, Seth. You should know this one. I'm not so stupid. I'm really brilliant. And it should be like, I should have known this because I'm so brilliant. If bars in progress does not equal 0, then return. Cool. That fixed it. Alright, so now I can go back and do the analysis that we were doing before. Which was to say, hey, maybe a 5% gap. Am I doing it a 5% gap? Maybe a 5% gap, not big enough. Not big enough. We want 1% cap. Okay. Better. Better. Lovely. Lovely. So if there's a gap of more than 10% of the daily range, I would think that one would qualify though. They have a stupid debug tool. Plug in. You just shouldn't have taken it off in the first place. You should just make it really small. There you go. Okay, so bar somewhere around bar 496. Oh, that's right. Oh, my buffer's not big enough. Oh yeah, no, Monica. So the strategy that Midnight was describing was absolutely profitable, at least over the time period that he's been using it. It kind of sounded like he didn't, that it's not automated, so we don't know the long-term efficacy of it. Oh, I see. The reason that it's not drawing gaps on these ones is because there hasn't been enough days on the ATR for it to see anything, but now it does. Okay. Oh, I missed Midnight's question. Oh, what are those rectangles on the chart? Okay, so the rectangles on the chart are fair value gaps. Maybe you've heard of it. It's kind of a popular thing out there. And I created an indicator that draws the fair value gaps and then says, you know, which, when does it get retraced, essentially. Now, I have some other stuff in there that, like, optimizes the drawing of it and so forth. So I do think, actually, we should go back and fix that again. This is just for debugging purposes. Basically, I put all of the gaps into an object that allows me to query it. And so then, based on where I'm looking at, I just go in and say, is it visible? And what we were doing is we were changing it, because if you have it so that you can anything, then any gap ends up showing up, and like there's way too many of them. There's just like way too many of them. So we changed it so that you can use the daily ATR to filter down as to how many of you show. So we were looking at 10% of the average true range. If we go to 5% of the average true range, then you get more gaps. Ta-da! Interestingly enough, on this move down here, they did not make gaps. And that did not draw a gap, which is very, very interesting. Is this a double gap right here? Oh, Debo, what's that? Oh, because that's the overnight gap. Yeah, gotcha. So the issue before was, well, you get too many gaps. Okay, so we've changed that. Now you use it. How are you going to use it? When there's a gap, you try and take the bounce off of it, something like that. But the cool thing about it is that it you know, like when I do that, it's only drawing the number of bars that need to be visible. And yeah. So it's more efficient drawing, because the other indicators that do draw gaps for you, it adds so many drawing objects on the chart that it's just like, it screws your chart up. So I have the best fair value gap indicator for NinjaTrader now. I don't know if anybody cares, because I kind of feel like Do you want to trade? I don't know. There's people that will want to trade it. There's people that will want to trade it. So I don't know what to tell you. Okay. It depends on how much expectancy it has, because if it's just a 3% edge or loss, it's just not statistically significant. Yeah, well, but you know, this is going back to the conversation that we were having earlier, Monica, that you might not catch if you're just reading the log. Is that part of the issue is how many data samples do you have? So if you run it over 5 years and you're taking that trade once a day, then you know you're going to have a couple hundred of data points. But because markets are fat-tailed and a couple of other things like that, you really want a lot more than that. So there's that kind of an issue. But granted, it sounds like, you know, if you've done it over 5 to 10 years, then you've done the best that you can. And I'm not going to say that would be a reason to not trade it, but that would be a reason to be skeptical. That would be a reason to be like, you know, like you can run it, but you know, don't be surprised if it doesn't work anymore. It's kind of things like that. So, right. The issue that you're going to get, though, is that it's not the win rate per se as it is the R factor. So remember, the R factor is what? Average win over average loss. If so R equals, okay, if R is less than 1, then kurtosis goes up. Okay. Kurtosis is a measure when we have a distribution like this. Kurtosis is a measure of this thing right here. Let's say KN, K negative, because there's also kurtosis positive. Okay. The issue with strategies that have R factor less than 1 is that it increases the kurtosis. It increases the length of the left tail. That's straight up what it does, right? Your losses are larger than your winners. So the largest possible loser is larger than the largest possible winner, generally speaking. Or like your largest possible losing day, it's like if we're doing an R of 0.5, that means your losers are twice your winners, right? Then if I have a day where I lose 50 trades that day, right? And I have a day where I won 50 trades that day, the day where I lost is going to be twice as big as the day where I won. So this tail ends up being twice the length of this tail. AN ends up being twice the depth of KB, right? And the issue with these is that your data set might not have enough data samples to see these. And so basically, the lower R is, the more data samples you need for a statistically significant result. Is what it means. Let me say it again. The lower your R is, the more data samples you need for a statistical significant result. Exponentially so. And I mean, like, for these trades where the R factor is less than 1, you want like tens of thousands of trades. Right? So that does not mean that a strategy cannot be profitable with an R less than 1. But what it does mean is those strategies are not very suitable for beginning retail traders, right? You're a beginning retail trader, You're trying to trade the market and build intuition off of it and all of those sorts of things and figure out, okay, well, in this situation it matters and in this situation it doesn't and all of those sorts of things. Well, if you really need 10,000 trades to be able to sort something out about it, then that's not going to work. You're never going to be able to build intuition off of that, right? So what you need to do is you need to have an R factor of around 1, where your winners are equal to your losers. And now you're getting more accurate feedback from the market. How much you win is going to be related to how good you actually are at predicting the market. Okay. Now there's this other side, which is strategies with really high R factors that are, above 1, that are like in the 2, 10, 50, etc., 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 right? Well, if you find a strategy that has an R factor of like 100, then it doesn't matter, right? Those are things where like, as long as you're not like really blowing it all and you're able to trade enough times to be able to find that one big one, all you have to do is find that one big one once, right? But those strategies are kind of better suited for automation because, or you at least you really have to have like good statistics backing you up, right? Yeah. But see, Monica's been asking these questions about the risk to reward, right? And that's the key insight. What I just told you is the key insight that the vast majority of retail traders do not understand. So if you want to know more about it, you go and read Nassim Taleb's book, Fooled by Randomness, because he basically goes through how you can do a back test or you can have performance on a strategy and it looks really, really good. And then all of a sudden, one day it just blows up. And and it's because the markets have fat tails, is basically what happens. So you're going to see a lot of people, and I mean a lot of people in the retail trader. If somebody comes across a strategy that is like profitable over a 1 to 2 year period, it's almost certainly the case that it does not factor in fat tails, because you've got like here. If I have a space here, then this space represents all strategies. And this space right here represents all profitable strategies. These are the profitable ones, and these ones are let's do it the other way. These ones you make money, and these ones you lose money. Okay, well, first of all, let's change it to really more like this. Right? Most strategies are not profitable. Few strategies are profitable. There are going to be some strategies that appear profitable over short terms, but do not account for the fat-tailed nature of markets, right? And that group of strategies looks something like this. Or like, yeah, there's some strategies with that negative R factor that do work, but most of them don't. So when you're using that R factor, you really got to keep in mind that, like, okay, if it seems like it's working to you, but you don't have enough data samples, chances are it really does fit inside this bit of it, right? But then, interestingly enough, if we graph this, so remember I said that your win rate is equal to 1 over 1 plus R. Well, if you graph that out, you basically you get something like this. Here's the graph. And this is going to be your win rate, right? And this is going to be your R factor, right? And this is going to be 1 R. So at 1R, your win rate is going to be 50%, right? And if you were able to get R to 0, which you can't, but if you were able to get R to 0, your win rate would be 100%, right? So you get something like this. And then that goes on forever, right? So if your win rate is above that, this is the zone of profitability, right? So what does that tell you? There are more profitable strategies with high R's than there are profitable strategies with low R's. But then there's this other side of it, which is, you know, if you're trading and the market's this volatile or whatever, right? If you got an average position and your target is closer than your target is less than the average volatility of the market, and your stop is more than the average volatility of the market, then you're going to make money. So the higher your stop is, higher the chance that that trade is going to win. So this kind of will cause you to optimize your strategies towards having a really large stop, essentially. When really the thing that makes you the most. But now here's another thing, is that on a day trading basis, you have to cut it off right here. You can only get like 5 to 1, 10 to 1 are like very, very rare payouts on a day trading basis. So that kind of cuts this off. Another thing is that these ones you can kind of think that you're in this area just randomly, you know, it'll seem like that's what's happening. These strategies are more likely to fool you. Whereas if you're over here, very difficult to catch those by luck. Okay. So if you have a strategy and you're getting a really high R factor, so your average winner is larger than your average loser, and you have a percentage that's higher than what should be for break even, like substantially higher than what it should be for break even, it's much, much more likely that it's a profitable strategy, or that strategy will continue to work into the future. That makes sense? You have it backwards, actually. Negative RR offer more edge than positive R. No. I mean, there's less of them. There's less of them. Just by the pure possibilities of what's out there. It's just that day traders are going to trend towards the low R ones. But don't say negative RR, right? So what happens is, the word that we've always used is risk to reward. So then I say that must be risk over reward. Okay. But when you actually get into the math and the algebra of it, this is not a very convenient way to express it. R factor. Is your R greater than or less than 1? Anyways. But again, if you're discretionary trading, I highly recommend that you go for an R of 1. If you're a discretionary trader and you're just starting out, I strongly recommend that you have an R of 1. Then if you really start to build good edge, and this is where it's like, okay, you know what's going on in the market. You have predictors of order flow. You're following news. You have things like that, right? Okay, you've built real edge. Now you can start having a really huge stop compared to what you typically make on average, and let them ride. And that additional risk really supercharges the profits. But you only do that after you've developed the discretionary edge, because the messed up R factors will basically prevent your mind from being able to develop that intuition. If you have an 80% win rate and a risk of 2 and a reward of 1, you're highly profitable. Maybe you're highly profitable. So yeah. Again, so you're abusing the law of large numbers is what you're doing. So if I have, here's what I'm saying. If I have infinity trades, and on average my winners are 1% and my losers are 2%, okay, and my win rate is 80%. Over infinity trades, yes, you have a profitable strategy, right? But what if the number of trades, N, is less than 10,000? If N is less than 10,000, the chance of that win rate staying at 80% are actually quite low. And when you get to 100,000, you'll find that your win rate is actually closer to 60%. That's the way that it tends to work. You get what I'm saying now? People think that they're getting win rate of 80%, but they don't. The market fools them. The market fattens you up. They say, oh, look, you're such a great trader. Look at how much money you made this month. You're so good at this. Look, you're hitting this 80% win rate. You figured it out. You're the profitable trader now, right? And then what happens next month? Wham! You just get absolutely destroyed. Absolutely destroyed. And it is like a predatory thing. It's not just like, okay, if I go and I do a back test and I say, here's what my win rate is, like my theoretical win rate, or even like the actual win rate of the strategy is like 60%, right? What is the chances that I would lose 11 times in a row? Okay. Well, there's models that you can actually go and search. I don't think we really have time for this, but you can go online and search, and there's like these tools that will show you like the risk of ruin based on your win rate and all of that sort of a thing, right? Okay. You're winning most of the time. 11 losers in a row, like the chances of that happening are like insanely high. The chances of that happening are like practically nil. And you know what? It'll happen almost every time. It'll happen almost every time. Because what happens is a particular strategy starts to do well, and then the market kind of catches on to it and starts trading against that strategy. How many trades do you need, according to you, to deliver a true or extremely close, accurate win rate? Okay, so there is a way to calculate this. If you read Nassim Taleb's books, he basically goes into it, but it's exponential. So if N is the number of trades needed, and how do I do this? Okay, so if the x-axis is your R factor and the y-axis is the number of trades needed, okay, the graph of the number of trades that you need based on your R factor looks something like this. Okay. And it tends to be something like, if this is, I'd say this is 1 and this is 2, right? Somewhere around here, you need like 50 trades, okay? And when you get over here into ends of like 0.5 and below, you need like 10,000 at least. Is what I've found. Okay, so there's the side on just from, are you properly factoring in the fat-tailed nature of markets, right? Then the second one is markets change, right? Like the way that the market behaves during a financial crisis is different from the way that the market behaves under normal circumstances, right? So in addition to having an adequate number of trades to statistically prove the thing that you're doing, you would also need to have a wide enough time frame to incorporate a large array of market types. Okay, and the number that one comes out to, and they tend to be about the same, is, for a strategy that's taking like this low R factor, it's like a day trading strategy, tends to be that over 5 years you'll be close to 10,000 trades. But 5 years for, if you've got something that doesn't have that problem, you still want 5 years. Okay. And if it's possible, you really would want like more like 10, right? Now, if these are day trading strategies, if you're talking about like swing strategies, then you need like 30 years for swing. Okay. So let me explain this a different way. Okay, so infinitely technically, but you should know super fast within 100 trades. By 10,000, you'd be at the lowest part of the curve. So let's do a much more limited example. Okay, let's say that you have R equals 1 and P probability equals 51%. You win 51% of the time. So you have a 1% edge. What does that actually mean? If you take 100 trades, 51 were winners and 49 were losers, which means 51 minus 49 equals 2. That means that 2 trades are responsible for all of your profits and losses. You see what I'm saying now? So how much do you want to bet that if that was over 100 trades, that the chances that the next 100 trades, that percentage will hold? And the answer is not very good. There's enough randomness that's very unlikely to hold. Okay. So now you start going on orders of magnitude. If we have 1,000 trades, then that would be a difference of 20 trades. Well, I mean, that's still like 1 or 2 weeks of trades if it's a really high frequency sort of a thing. It's not that many trades, guys. It's not that many, right? It's only when you get to 10,000 that you're talking of a difference of like 200. And now you're talking about something meaningful, right? So it's almost always the case that the number of data samples that you need to really have a statistically significant result is more than you think. And I'll tell you something else, and this is the really devious thing about it, is that the tools are kind of are often limited to exactly the spot where things would make sense. Like if you're really serious and you really want to be, backtesting over this huge data set, guess what? That's going to be less years than what your data broker gives you. And that's why, so I say 5 years, but a lot of data brokers will only give you 2 years worth of intraday data. Why is it only 2 years? Because if they gave you 5 years, then you could actually do real shit. Right? So you need a lot of data samples. So especially with these low R's. So when you see these people out there that they're trading like, you know, R.5, which is a lot of people. It's like super popular right now. They almost certainly do not have enough data to actually be claimed. Like really, I guess the larger thing is that like to claim oneself as a quote unquote profitable trader is really deceptive, right? If people ask me, oh, are you profitable? Sometimes, right? Because profitable doesn't take into account time frame, doesn't take into account how long it's been that you've been doing it. If you've been profitable over 5 years, and I would say like, especially if it's every year in those 5 years that you were profitable, now you got something and I want to see what you're doing. But before that, in my opinion, it's probably just noise. And that's why I don't like, I'll have people come in here all the time. And they're like, oh, here's what I'm doing. And I'm like, oh, please tell me what you're doing. Is no, because it's like, if you haven't been doing it for 5 years, then it's like probably not worth my time. And that's why when I did that back test that we did earlier, right? I wanted 5 years in it. Well, you can curve fit to 5 years, and maybe we did that, but we'll see what forward test it and see how it performs. CQG only goes back 15,000 bars. Oh, I think you can get more than that with CQG. I think you can get 2 years worth of data. But yeah, that's a problem with the 1 minute bar as well. Are you profitable over your career? That's a good question, actually. I think it's probably no, but it's probably close. So let me tell you something else with the way that I do things is that to some extent, day trading is a little bit of a loss leader, which is to say that I learn a lot about the market that allows me to make longer term trades. And so when you look at my longer term trades, I've made a lot off of this. But when you look at the day trading in particular, it's most years it's down. So like this year, I think it's going to be down. The year before that, it was up. It's just, you know. But then what happens is I get like, I'm not making a lot of it. Everything that I just told you is like extremely statistical. Like I just listed out the math for you too. I don't get what particular thing did I say that you don't agree with? Time for me to get going now. My so for my data broker, I have Rhythmic. It gives me intraday data going back to 2012 now, I think. So I can get 12 years, 10 years of data in there, more than that. But if I want like tick replay, that only goes back a year. That's why we're saving the data ourselves. Anyways. But you know, fooled by randomness is a place where if you really want to get into the math of all of this sort of stuff, then you can get into it. But oh yeah, but anyway, so I forgot what I was talking about before I got into that. Okay, so the longer you stick with it, the higher probability of success. Well, I suppose, but okay, so like when you look at a graph of so I'm going to fill in a lot of data here because the data that we have on this is a little bit limited, okay? But like the percentage of people that fail when you start out, and depending on which asset it is, it starts at like something like 80% of traders fail, right? And by the time that you've gotten to 5 years, we are now at 0.2, or actually it's worse than that, right? It's well, anyways, basically by this point, 80% of people have already quit by 5 years. Actually, I think it's by 2 years, 80% of people have already quit, right? But like people will come in and they seem to think that like, well, if I stick with it and I've been trading for 5 years, then the chance of me having been successful starts to get high. And the truth is that you never get to 50% of people are profitable. Like it's a zero-sum game. So it's always going to come out to that like the people that are really like truly long-term successful, like, you know, make money every year after 5 years and then they continue it every year after that sort of a thing. It's like literally 1% or less in futures, at least. You're taking the big assumption that every trader makes is, what does that have to do with anything? I'm just going down like if your risk to reward ratio and how that affects the statistical distribution of your results, and why the market being fat-tailed can kind of fool you. So there's another way. There's the opposite way of looking at this, okay? Which is really what the best thing to do. Just straight up. I'm just straight up telling you, okay? You want something that looks like this. And the line goes way off the chart. Okay? If you have something where when you do it and it wins and you make $100 million, think about how many times, like, let's just say that we played a game, and if you lose $1. And if you win, you make $100 million. How many times would you have to play before it wouldn't make any sense, right? So basically, if you play it 100 million times and you lose every time, and then the 100 millionth time you win, that would be break even. You guys have any idea how big of a number 100 million is? That is such an insanely huge number. It's just like let's ask ChatGPT or Google a question. How long is 100 million seconds? Oh, maybe we don't want to have 100 million seconds. Okay, so that's like $1 every second for a day and a half. Right? Let's stop with the assumption that every trader uses the same risk reward on every trade. In order to show you the statistical properties of the way that these things work, you have to understand that the risk reward, right? Yes, we're making this straight assumption, okay, that every time that you win, you make a certain amount, and every time that you lose a certain amount, right? To show you, hey, then how many trades do you take in a day, and how many wins do you get, and you get a distribution like this. Right? And then you get a long side. Yes. Now, what do you actually want? What you actually want is that a graph like this of an individual trade. if you have a graph like this of an individual trade, every once in a while, that trade goes really, really well. You have a far right tail. And if you're using a set risk reward ratio, you never will catch this tail. So I would not recommend using set stops and targets. Let me say that again. I would not recommend using set stops and targets. But the discussion was, how many data samples do you need for a statistically significant result? And that's why I was explaining it that way, Tilt. What you're talking about, whether they use the same risk reward on every trade, is completely irrelevant to that particular question. If your assumption is flawed, well, yeah, but this assumption is one that allows us to even show you math about it, right? You're taking different ones. That doesn't really change anything about how many samples do you actually need for statistically significant results. Okay. I'm just telling you that there is a strong relationship to your R factor and the number of samples that you need for a statistically significant result. Okay. Now, of course, you don't take, every trade is this. So then what you actually do is, again, remember I said R factor is equal to average winner over average loser, right? So we are kind of accounting for that, right? Because I'm saying you trade for a year and then show me what your average winner and your average loser is. And that's your R factor. So you were profitable after a year, but your R is 0.5. That I'm just telling you, the chances of that strategy continuing to be profitable over a 5-year time period aren't actually very good. But if you do this over a year and your average win is like 2 times your average loser, and you were profitable over a year, because your R is higher, the chances of those results persisting over a 5-year period are significantly higher than they were at the 0.5. Now, if you have enough data, if you're able to test this over like a 10-year time period and have several tens of thousands of trades and it still works, then it's a moot point because you have enough data, right? I trust your assertion using fixed, but if the values aren't fixed, what's the point of proving the hypothetical? So, man, how do I describe this without like being mean? What makes you think that there is a relationship between the distribution of your average, your winners and your losers, and the number of data samples that you need for a statistically significant result? Right? So what are we saying? We're saying there is a relationship between R and K. Right? And you're saying, is there a relationship between I forget how we'd express this in mathematical terms. Is there a relationship between the distribution of your average winner or the distribution of your average loser in K? I don't know. It probably doesn't matter as much as the relationship between this. Yeah, you're right. R factor is equal to 1 in this hypothetical scenario. If R factor equals 1, all a trader needs is higher than 50% win rate to be profitable. Right? Yeah. And why does that matter? That matters because your mind, so your mind cannot deal with big numbers, right? Anything that's over like 250, you can't even really conceive of. Okay, so and you can't think about more than 250 trades, right? And what your brain does is it says, well, okay, I took 200 trades. How many won and how many lost? Well, I remember winning 100 times and losing 100 times, so maybe it's just random, right? It's just that's what your brain needs, though, to be able to like figure something out, right? So if you're doing something where your risk reward is equal and you're getting 50%, but sometimes your winners are larger than your losers, your brain figures out very, very quickly, this is what you should do and this is what you should not do. Whereas when you have this low R factor, for instance, then you're just going to think you're an absolute god all of the time, even if the strategy isn't actually profitable in the long term, right? Like you go and you backtest it over a year, has negative net profit, right? But the people that are trading that, because they're winning most of the time, they think that it's a great strategy. That happens a lot, right? And then on the split side, the ones with the high R factor, those people are going to think, oh, I'm an absolute loser, like nothing ever actually works, when it's actually strategy that does work over the long run. Because your brain can't see those larger distributions with the numbers. That's where that part matters, right? That's where when I'm talking to Monica, that's where I'm saying, like, I would really recommend that you just use equal risk to reward. If you're going to discretionary trade and you're new enough at this that you're asking me that question, you should use R1. And to Midnight, I don't know if he's going to backtest it or not, or if he has the ability to, or if he wants to send it to me to backtest it. But for that one, you would want a higher R based on how many data samples that you get. Now, we can test it over 5 years. So I think that, if it had an R of 0.5 and we had 5 years, then we would have enough data samples to be like, okay, yeah, that might work. That's worth trading at least. It's worth trying at least. Right? Yeah, but the whole well, it's not even a scenario. The question is, I'm trying to say, here are some specific suggestions I can give you about your trading based on this information that you get. Why would you take the giant assumption that the market behavior evolves, but the trader cannot evolve with it? That's absurd. So if you come in and you trade something and you win 80% of the time, how are you going to tell that there's an actual edge in that thing? How are you personally going to tell if there's an actual edge in that thing? You can't. The only way that you can do that is you take stats, right? You record every trade and how many times you won, how many times you lost, what you won or lost on each individual one of those things, and then see what the actual results of it was. Right? You're kind of trying to argue with me that the mind can figure something out that it is just not capable of doing. You literally cannot sit and watch 100 of something or 1,000 of something and then tell me, was it profitable or not? You can only do it with external tools. Okay? But when we're talking about intuition, that matters, because your brain is trying to figure out, does the thing that I'm doing here actually work? In order to give your brain, those brain cells that are making connections in there to try and figure out how to trade, in order to give them the best chance at developing a neural network that is effective, trade equal risk reward at the beginning. Build the network first, then supercharge it with risk. Let's automate my strat. Well, I'll automate it for you. Absolutely. I'll just about any strategy that somebody comes, whether you want to message it to me privately because you don't want everybody to know, which is probably what you should do in this case, or we're talking about it on stream. If we have specific enough entry criteria, I will automate it every time without question because it's fun. And it's not that hard for me to do. So if you send it to me, we'll absolutely automate it. I was under the impression that it was already automated. You ever seen an algo run long term that was profitable on a lower short term time frame? So I can give you some background information about this. So when I worked for the bank, well, Goldman Sachs Bank, I usually don't say who it is because by not telling you who it is, people know who it is. But when I worked for Goldman Sachs, they had market making algorithms that were profitable like 90% of days, right? They would make significant changes to those models every 2 weeks. Every 2 weeks. Every 2 weeks, they were either learning something new to add into the model, or they were seeing changes in the markets that they needed to start to account for every 2 weeks. Isn't that crazy? To find something, especially something that just uses like a 1 minute chart of ES and is profitable over 5 years, it's truly like a rare event. They are very I don't know if it actually exists. I don't really believe that it exists. I've never seen it. Because, especially intraday. If you're doing like a momentum, then it's a different thing, right? Like these kinds of methods that most retail traders are trying to use work much better on daily charts than they do on intraday charts. Okay. But yeah, that's just to tell you how that goes, right? The thing that's so crazy about it, is that if you're trading like daily bars, okay, you come up with a strategy and you do a swing strategy or something like that, where you're buying individual stocks or individual assets, better than 50% chance that you will make money. You won't beat the market, but you will make money. Really, when you go in and you look at that, like, why would you day trade versus swing trading? There really has to be something else to it because your chances of success are so much better with the swing. So it's like insanely so. No. So Midnight, we could potentially sell it with less than a 5-year track record. So if we had 5 years of back-tested performance, we could potentially sell that to people. Now, the problem I think that you're going to find is that it's not, the performance of it isn't actually going to be attractive to an investor like that. Because basically the way that this works is like, in order to make it worth it, by the way, you would want to have like $10 million of assets under management. So what you do is you have the model and then you go to people and you say, look, here's what our thing, this is generally what it does without giving them all of the specifics. And here's how it has performed over the past 5 years with all of the caveats that these are back-tested results, and there's certain limitations with them and so forth, right? And then you would go out and you would try and fundraise $10 million. So going back to the thing where I was saying like their market making algorithms, they were like changing them every 2 weeks. Okay. But you know what else? Those things also incorporated order flow and correlated assets and outside data from outside the market, like sentiment and all of those sorts of things, right? So that's the other side of it, is that if you are going to get into day trading, you need to go beyond just the charts. You need to go beyond just the charts. All the retail traders out there, they're trying to make money from day trading by just looking at a 1-minute chart. It's probably not going to work. I don't need to capture the same moves an institution does to make money. Well, that's probably true. So you might not need to update them as much, but it's just giving you an idea about how dynamic the markets are. I gotta say, I mean, like the bigger thing here is, okay, like just this. I give you the challenge. This, seriously. Oh, where I need to come up to here. Strategy analyzer. Which one was it? Okay. If you can find me a back test in NinjaTrader using 1-minute bars, some people will cheat. They'll use like they'll use range bars or Kage bars or weird things like that. Okay, 1-minute bars, S&P 500, 5 years of data. If you can find me something that performs better than that, I would pay money for it. 100%. If you could find me one with a Sharpe ratio over 1, now we're talking. Now it's like, now you start a fund with that, right? And I can put a bond. I don't know how much I would be able to put up on that. Like, I don't know. I'm kind of between chops right now. Normally, I'd be able to say like I would pay like $100,000 for that or something like that. But you're not gonna find it. like the chances of any of you guys finding and bringing a NinjaTrader backtest like that to me are like practically no. This is just that hard to do. If you get on a Sharpe ratio of 0.5, that's like, wow, you're doing good. And that's basically like buy and hold. Do we have that? Let's run that one real quick. Buy and hold. This is every day. So this one, it's still, like sells it at the end of every day. Yeah, if you can find me an accurate backtest that forward testing can replicate, yeah. Okay, so look at this. So my strategy was pulling like a 0.2 Sharpe ratio, something like that, right? If you just at the beginning of the extended session buy and then sell at the end of the session, you made almost twice as much. And you got a better Sharpe ratio. Is that actually that great of a strategy? We'll see. Might be able to pass a combine. We'll see. Right. Here's then this one right here. This is buy and hold once. Buy and hold once is basically, let's see here. There's this break at end of day. I just have to take that off. This is what you'd make if you just bought one contract and rolled it over at the end of every rollover, and that's it, and never did anything else, and basically just went long the S&P 500. So the reason that I don't use this one very well is because you only get one trade, so it doesn't really tell you the Sharpe ratio. Oh, wait a second, that can't be right. That can't be right. Oh, because it only took one trade, so why did it get out of it? I must have broken that strategy. But yeah, just message me on Discord. Just message me on Discord, and then, you know, I'm watching the kids today, but then early next week I probably will have some days in the cycle. And then there's like, while we're here on stream, because I can always, you know, I can always work on it. A lot of this stuff that I've been working on it off screen, right? So yeah. So on the, like, you know, is it comparable to an institution? Well, like, the issue with an institution is that there's only so much edge available at the market at any particular time, and you have to be able to size your trades, right? So like, if you were to do what they did and you're only doing one contract, that would almost certainly still work, right? But there's plenty of things that don't work for them because there's not enough, you know, they can't trade enough size on it for it to be worth it, where it can make money for you. So, you know, like this thing that, like, can you double your money trading futures? Well, sure. You absolutely can. Can you double your money every month? Probably not. Probably not. But I'm sure that you could try making a strategy that does that. Okay, time for me to go. Kids are up. I will see you guys Monday. Stay